This is Fintech Insider News. This week, we're talking about, is Stripe worth $70 billion? Because long-term investors Sequoia think so. OCN raises $86 million in Series A funding in their mission to support gig workers across the Americas. And Monzo is launching bank accounts for children with a choice of 3 new card colors, which seems totally unfair to us adults who are still stuck with hot coral. We discuss all of this and much more on today's show, so don't go anywhere.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, how to get 30, how to get 20, 20, 20, how to get 20, 20, how to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 up front for 3 months plus taxes and fees. Promo rate for new customers for limited time. Unlimited more than 40 gigabytes per month. Slows full terms at mintmobile.com.
Hello and welcome to episode 880 of Fintech Insider. I'm Laura Watkins, Director of Media Marketing at 11FS, and I'm joined this week on Fintech Insider News by 3 guests who are here to break down the biggest stories from the past week in fintech and financial services. But before we get to them, please welcome my 11FS colleague and co-host for today, Nadine Timmer-Bodenstein, Ventures Product Lead at 11FS. It's great to podcast with you again, Nadine. Can you tell the listeners what you've been working on recently?
Yeah, absolutely. Great to be back, especially on, I think, what is probably the hottest day of the year so far in London. I'm trying to stay cool in my little office here. I am actually gearing up to start a new project next week, which is quite exciting. It's a slightly different focus area to those I've done before. So this time actually delving into the world of corporate trust management, specifically looking at how we can actually improve the digital experience for both employees as well as clients of the company that I'm going to be working with. So looking forward to trying something new.
Amazing. Oh, that's really interesting. And also, we're saying it's the hottest day of the year in London when we're joined by people in much hotter climates than London. So let's welcome our next guest. So welcome back to Fintech Insider for Miguel Armaza, co-founder and general partner at Gilgamesh Ventures and Fintech Leaders podcast host. So it's always great to have you on the show, Miguel. How are things going at Gilgamesh and where are you joining us from today?
Things are going great. First of all, thanks for bringing me back from last time. I'm in New York City, and this has been one of the hottest weeks in memory. So it's we're doing well. And things are going great. Actively investing and trying to find the best founders in fintech.
Oh, amazing. Well, it is great to have you back with us, and we're definitely going to need your VC brain for some of the stories today. So really, really happy to have you here. And next up, it's a warm Fintech Insider debut for Mairon Sandoval, CEO and founder of OCN. Welcome, Mairon. You've got some exciting news, which we'll get into shortly. But first, could you tell our listeners a little bit about yourself and OCN?
Thank you so much. Very excited to be here, and thanks so much for having me. Yes, finally, big news coming out this week. So very excited to share with the public tonight. And OneCurve now essentially and myself providing easy access to gig workers that currently don't have access to credit. That is our mission. And we're super excited right now in Miami to be able to provide these financial services also in the US, not only Latin America. And very excited to share more about the news in the podcast tonight.
Amazing. And you are in Miami right now?
Correct.
So even sunnier climes, like when London has nothing to complain about. So, and last but no means least, it's a warm welcome to Anita Ramaswamy, financial analysis columnist at The Information. How are you, Anita? I think I'm right in saying you've moved companies since the last time you were on the podcast. What are you up to now, and how's it all going?
So yeah, you're right. I did move companies. So I'm now at The Information writing financial analysis columns, but I also moved cities. I moved from New York to San Francisco 2 months ago.
Amazing. So we've got San Francisco, we've got Miami, we've got New York, and then we've got me and Nadine in London. So covering a lot of bases today, which is great because that's what we're going to do on the show. So very excited to have you all with us. And let's get into our first story for this week, which is that Major Stripe investor Sequoia confirms $70 billion valuation and offers its investors a payday. So this story was in TechCrunch and in many other places. Stripe has been delaying its IPO for so long that its major investor Sequoia Capital is getting creative. They're offering to buy up $861 million worth of Stripe shares from their older funds limited partners, which would value Stripe at the reported $70 billion that we mentioned. Sequoia is willing to do this because they're super confident in Stripe's future, and they believe that Stripe will eventually go public and make everyone a lot of money. Stripe was once valued at $95 billion, but last summer it dropped down to $50 billion, and still, even with this roller coaster, Stripe is still one of the most valued startups. So Anita, let's start with you. You're on the ground reporting from San Francisco. What are people saying about this valuation and this kind of slightly interesting move from Sequoia?
It is really interesting and somewhat unusual. I think what I've noticed is that there's two camps of people in terms of the valuation. And that's partially because of the way Sequoia's structured this deal. Based on the reporting that I've seen, they're essentially, the buyers will be their newer funds and the sellers will be coming from their older funds who held the Stripe shares earlier. So really, it's a matter of, if you're a new LP in one of the Sequoia funds, do you believe that it's worth $70 billion? And, there's one camp of people that says, yes, the Collisons are generational talent. They're incredible founders. They've operated the business really well. And, that $70 billion valuation is justified. The pushback that I've personally heard to that is that you have a pretty close competitor, Adyen, in the public markets, which, if you look, they're trading around, $38 billion in market cap. So significantly lower than the valuation that Stripe has been ascribed. While they're processing similar payments volumes, they have a little bit more of a profitable profile based on the numbers that are floating around out there. So it really depends on how you're looking at this, whether you're looking at it more from a management perspective or you're looking at it more from a perspective of the financials as they stand today.
And Miguel, with your sort of VC hat on, what is your thoughts on this this sort of pumped up valuation from the last $50 billion that they were valued at before, which, to Anita's point, is still more valuable than Adyen, but this has jumped up by another $20 billion. What's your thoughts on that?
Yeah, actually, Stripe had a more recent one valuation that I think valued them at 65. But, with between 50 billion, 65 billion, who's counting? But the point is, if you are Stripe, if you're the Collisons, Sequoia is exactly the kind of partner you want, right? They'll support you from the beginning at the seed stage, and they keep supporting you at this stage where, now they're a massive company. And just I pulled some numbers, and just quickly to give you an idea, Sequoia has invested about $500 million total over the years in Stripe, and that is valued almost $10 billion. But the reality is that most of their gains came from Sequoia's seed and Series A investments. If you combine those two, taking 50% dilution, that still is worth about $8 billion. Right? Sequoia's seed investment into Stripe was $2 million, and the Series A investment was $18 million. And over the years, that has valued significantly. And so the point is, Sequoia has already made a lot of money off of Stripe. It has been a very successful decision. I suspect they might have sold some in secondaries, just looking at the math. And so I think they're just using some of the gains that they got from Stripe and just putting it back into the company while appeasing their LPs. So I actually commend Sequoia for doing this. It's a interesting decision that makes a lot of sense.
Yeah, that's really interesting.
Yeah, I think just building on from that, I think for me, what's interesting is actually, I guess, digging a bit more into the approach that Sequoia has taken and perhaps the rationale for this approach. I found some data from PitchBook and the NVCA that says that 37% of unicorns are being held for at least 9 years by VC funds. And apparently 13% of those are past the 12-year mark. So this also paints quite an interesting picture of perhaps how limited partners might be getting quite frustrated by, the lack of cash coming their way, because VCs are letting these startups stay private for longer, perhaps even sometimes past that hypergrowth phase, which would have justified some of these sky-high valuations that Anita and Miguel have touched on. So I also just think that that context is quite interesting in the setting of this news story that we're discussing.
Yeah, it's an interesting time, right? The market is at all-time highs, but there's barely any IPOs happening. What I got from a very, very senior banker recently is that there's about 100 to 200 private tech companies that have filed confidentially to IPO, but none of them are actually moving forward for the actual listing. So everyone's kind of waiting for the right opportunity.
Why do you think they're holding back? Is it a domino effect? Are we just waiting for the first one to go and then they'll all tumble? Or are they waiting for market conditions to change?
I think it's a bit of both. No one wants to be the first one. And yes, they're hoping market conditions are going to change. Everyone, if they can get a little bit of extra time, that gives them even more time to improve their margins. So it's a combination of things.
Mairon, what were your thoughts on this story?
So I think it's a very interesting move. I think Stripe is a very talented management team. I think they have a very strong group of investors. And in the end, if the investors are taking the decision to probably take and give the company, the management team, but the founders a little bit more flexibility in the decision making without so much public scrutiny, I think in the end, if they think that's the right decision, it's pretty interesting, right? Sort of these decisions that both the founders, but I'm pretty sure they had a good involvement to this decision. Also, the investors are taking towards the success of the company. Look, there's very limited information that we can get from the internal financial information from the company. And I think if investors and the founders are taking the decision, probably is the best for the company as well, right? So it's a very interesting for sure.
Yeah, and that's so true. Like, obviously, the fact that the very fact that they're not public means that like there's only so much we can know about the internal machinations. Anita, what do you think this means for the sort of general fintech investment scene more broadly? Is there anything that sort of is setting Stripe apart to this degree of valuation, as far as you can tell?
It's a good question. I tend to be of the camp, that perhaps the valuation might be a little high just looking at Adyen, but I do think there's something to be said for how this business has grown and, has growth opportunities ahead of it too. It's not just a payments business at this point. I mean, Stripe has introduced a number of other products that they're also sort of pushing and looking to expand in. I think for the broader fintech ecosystem, it bodes really well. And Stripe's higher valuation isn't the only positive sign that we've seen recently. I mean, if you think about it, Revolut is doing their secondary share and the valuation of $40 billion is higher than what they actually raised at in 2021. The other example that I was thinking of is Ramp, which closed around in April at a valuation that was also higher than the previous round that they took. So I think we're finally seeing fintech as a sector come out of the slump over the past couple of years. And also, I think folks are waiting for, signs that inflation is cooling, signs that maybe interest rates are going to come down, and those things are just going to continue to fuel the renewed wave of excitement that I think we're seeing around these companies.
Yeah, absolutely. On this show last week, we did have that question of like, are we coming out of this funding winter? And obviously we had the Nala raise that we discussed on last week's show. Weeks before that, we talked about Revolut. Now we have this massive valuation of Stripe. It very much feels like we are, at least from the headlines that we're seeing. And of course, Mairon, you've closed your own raise that we will come to discuss very shortly. What's your take? Do you think we're coming out of like the funding winter, as it were? Is the funding scene looking better, or is it still, quite tough to get these kind of deals over the line?
I think for sure it's better, but there is a point to be made on the fact that if you are a company trying to raise capital, the dynamics for that environment have completely changed, right? Capital is not as, I would say, accessible as it was a couple of years ago. And the point here is it might not be difficult from the proper dynamic of venture capital, but it might be more rigorous in terms of the metrics and sort of stage of the company, or sort of the stage that the company needs to be for you to be successful in this fundraise campaign, right? So I don't think necessarily, it is true, of course, that the markets have completely changed, but not for the bad, I would say. I think it's allowing companies that are more conscious about capital efficiency, conscious about expense, to be the ones that are actually raising capital, are more resilient in terms of the operational expense. And I would say that is a good thing overall for the industry, right? Because maybe not today, but a couple of years from now, we're going to see very resilient companies that took the right decisions at the right time and therefore were the ones successful in these fundraising campaigns.
Absolutely. And Miguel, you're nodding vigorously throughout that. I'm going to give you the final word to wrap us up on this story before we move on.
I'll just add to what Mairon said. Every single round that you're seeing be announced either by Anita or any other reporter out there was a lot of work that went into that round. It's not easy these days. We just saw two of our portfolio companies. They recently closed large rounds. Each one of those took 3 to 4 months, right? And the metrics that the companies have to present, the bar is much higher than it was 3 years ago. But it's not impossible, right? We are seeing it. So, yeah, definitely the market is back for healthy companies.
And that takes us very nicely into our next story. So, which is Fintech for Gig Workers, OCN, raises $86 million. So the story was in Fintech Futures and elsewhere. So formerly known as One Car Now, OCN just completed a Series A raise in their mission to support gig workers across the Americas. Leading the equity round are Caravella Capital from Brazil, Collide Capital, and Great North Ventures from the US, with the debt financing coming from New York's I-80 Group. OCN is on a mission to become the top financial partner for gig economy workers. They're growing fast in the US and are eyeing a global presence. Their goal is to provide financial support to these workers, who they say are often ignored by banks, and give them tools to boost their earnings and improve their lives. One Car Now started as a car subscription platform that offers customers in Mexico an easy and innovative way to get a new car without the hassle of ownership. And of course, we are joined by OCN CEO and founder with us. So Mairon, congratulations on this raise. What can you tell our listeners about this, particularly on your sort of expansion plans and those new products and services you can offer to this market?
Thank you so much. Yeah, it's very excited to finally get the news out. Even though the round was closed a month ago almost, we decided to wait a little bit on the announcement just because of pure market dynamics. And we're super excited about our mission. I think since day one, our vision has been to be able to provide any sort of financial product for the gig economy. Let's remember, this is a segment of the population worldwide, not even in emerging markets, where they may not have a credit score, they may not have a cosigner, they may not have capacity to put money on a down payment or security deposits, and therefore they're left out from many financial institutions, right? Whether it's cars, whether it's motorcycles, whether it's a credit card, whether it's a personal loan, gig workers oftentimes don't have the capacity to have access to these financing products, right? So since day one, our vision was a broader, I would say, platform, not only in terms of the vertical of cars, but financing products as a whole, and be able to provide and partner with gig economy workers to provide these financial services for them. Now, we started with cars. How do we see both the strategy in terms of product diversification, how do we see market expansion? I think it's a different perspective and way to see it. Market expansion for once. Mexico, as being an emerging market, I would say socioeconomic profiles or backgrounds of gig workers are going to be pretty similar in a lot of various emerging markets, right? Whether it's Brazil, which is the next country we're expanding to early next year, or whether it is Middle East, or whether it is Southeast Asia, or even Eastern Europe, right? But the assumption was, what if we can target a very niche segment of the population that may be immigrant, that may be probably considered to be a subprime market in developed economies, right? And therefore, we decided to expand in the US with the value proposition of electric vehicles, and therefore not only creating an impact on the gig economy access or capacity to have access to cars in this specific vertical, but also making more money because of the incentives that platforms like Uber, like Lyft, like InDrive are providing as incentives to transition their fleet into this electric vehicle component. And on top of that, saving them Almost $600 to up to $1,000 per month on gasoline, right? So the assumption is if we are able to target these very specific niche segments of the population in developed economies, we could do it even in other markets outside of the U.S. as well, right? Not talking about Europe, more established economies or developed economies in Asia, more developed economies in other parts of the world. And in terms of product diversification, I would say we started with the most compelling product that we could feel comfortable with, right? Cars in the end are an asset that it's easy to buy, easy to repossess, easy to sell whenever that needs to happen, right? Whereas lending money to the gig economy, we've seen in emerging markets, we've seen in developing economies, that is a very, very different game, right? So for us to feel comfortable with this, I wouldn't say risk, but yes, challenge, we started with an asset that we could feel very comfortable in our operational capacity to have performing in terms of the portfolio, right? And that was cars. Cars started in Mexico even as a marketplace. That was day zero of One Car Now. We were connecting car owners with gig workers that don't have access to credit, and then we transitioned to what OCN is today, which is the platform, the financial platform for us to provide these working capital for the rideshare workers.
Amazing. What a journey from one proposition into a whole suite. I think, that's kind of how some of the best companies have started, particularly in the kind of like ride hailing and kind of becoming super apps now. Is that your mission ultimately, to kind of ladder as many products into the platform as you can?
Yes, the mission today is we've built this technology platform that essentially allows us to have very deep information about a gig worker's track record in terms of the gig economy performance. Now we are also connected to their personal finances via open banking, and we of course run constant background checks to make sure any legal litigations or affectations that a person may have, in this case, our customer, right? And therefore, we're able to partner with other financial institutions for them to join our marketplace and essentially provide their services to the gig economy, right? Now, let's imagine that you are a bank in Mexico, you're a financial institution in the US, and you are not providing financial services to the gig economy because you don't understand the risk or the challenge that lending money to this specific segment of population involves, right? And then OCN's marketplace essentially involves that we are going to provide underwriting as a service, services for them, collection as a service, and even repossession as a service on their products, right? So therefore, they have a platform in which they can offer their services to the gig workers, which is a market that they currently cannot have access to or offer their services to. And therefore, we are going to be able that catalyzer for them to feel comfortable with this sort of challenge of entering the lending play of the gig economy.
And Nadine, you are our product lead at 11FS. What was your kind of thoughts from a product perspective of this news and everything kind of Mairon was just telling us about future plans?
Yeah, absolutely. I suppose, firstly, congratulations, Mairon. I think it's an incredibly exciting business, really compelling opportunity. I love getting stats. So I did some Googling earlier and I found a number from the World Bank, which estimates that there are 435 million online gig workers globally. And so their definition of that online gig worker comprises, I guess, two subsegments. One, location-based gig jobs. So some of the things that Mairon was touching on around, ride sharing, delivery, kind of an order is placed online and someone actually delivers that physically to the customer, as well as online gig jobs where the entire process is delivered online. So that might be something like, performing a side job online for a customer. So I think, firstly, there's no doubting the opportunity. We've done some of our own research at 11FS on this opportunity, and I think I really echo one of Mairon's initial points around the kind of socioeconomic conditions and how they're not going to be too different across the different markets. I think there's also parallels with other customer segments. When I think about one of the biggest challenges facing these workers, which obviously is all centered around the fact that their income could be irregular or unpredictable. They lack in the kind of traditional employment benefits. There are some parallels as well with a lot of research that we've done with students, particularly around creditworthiness and how individuals want to start getting a credit card to build up that credit score because they have an ambition one day of perhaps purchasing a house, which is quite a common ambition, especially in the UK market, but they just don't have, the steady paychecks to prove their creditworthiness. I think on the income volatility and unpredictability point, this is also one of the biggest pain points that has come up time and time again. The fluctuating income, making it not only difficult to actually meet requirements by banks and lenders, but also as an individual, it makes it very difficult for you to manage your money holistically if you're not actually sure what your bank account is going to look like month on month. So I suppose from a solution perspective, we've discussed a few times with different clients, the ability to help with income smoothing and actually just smoothing that out in whatever way you see fit, so that income can be more predictable, less volatile, to then enable the subsequent actions that the customers want to take. And then the kind of third area that we've also done research on before is around actually savings and investment challenges. I think these workers often don't have traditional retirement plans. And so how we make sure we actually help them with setting up and managing savings, whether that's for the retirement or perhaps another goal that's slightly shorter term, is also something we've discussed before as part of the kind of overall value proposition here.
Yeah, absolutely. It's an enormous space. Anita, as a journalist yourself, which is also can sometimes be one of those gig economy freelance professions, what's your thoughts on this?
I mean, I think it's a huge opportunity, and there are so many different companies that have tried to serve a community that is otherwise underserved by traditional financial services. And I think it makes a lot of sense to start with this really specific focus on cars and then maybe expand out from there. There's tons of challenges that are unique to gig workers as well, or at least more prevalent amongst gig workers. And I'm thinking about, some of the startups that are working on things like earned wage access, to your point, Nadine, to smooth out the income that some of these workers are receiving, because it can be really challenging to manage all your bills at the same time as trying to manage the income streams that you're making.
Absolutely. And Miguel, again, this is a funding story. What's your kind of thoughts on this? And also sort of, there's a lot of ride sharing and so on in New York, and huge amounts of gig economy work. How big could this be? The world seems to be Mairon's oyster with this opportunity.
Yeah, in New York, ride sharing has only gotten more expensive, but the usage still continues because it's so convenient. I've known of Mairon for several years through one of his investors and a good friend, Ivan Montoya. And so I'm very happy to see all his progress. Truly, hats off to you. And the beauty, I like the business of OCN for two reasons. Number one, gig workers are not going away, and they need financing. And if you do it right, this pays for itself for the user, right? But number two, and I'm sure this is something Mairon thinks about, you don't need 1 million customers to become a huge business. And that is the problem for a lot of consumer fintech, that sometimes if you don't get a few million users, you barely have a business, right? But that's not the case for OneCar now, for OCN. And so that makes it a very scalable and attractive proposition for investors and also just as a company.
Absolutely. And I'm really happy that Fintech Insider can bring you guys together if you've been following each other's journeys for a while, but, maybe not met. Mairon, we've been talking a lot about your company, but I want to give you the final word just to kind of wrap up any closing thoughts on this raise before we move to the break.
I think to the point we were making earlier today, I think, look, market dynamics in terms of venture capital have changed, right? Significantly since 2021. I remember being one of those founders when we were launching the marketplace that used to feel almost like left out of these whole VC dynamics, right? And I remember rounds getting announced 3 times per week, right? And then, Miguel, I'm pretty sure you remember this, but there was this whole unicorn list, right? About like huge momentum that VC funds, that of course investors, angel investors, wanted to create around the venture capital in the startup world, not even in Latin America, but worldwide, right? And I think that was pretty interesting because it has substantially changed to what venture capital means today, right? I think venture capital today, it still is looking to back very strong teams, very strong founders, very strong theses, very strong companies. But now the metrics and probably I would say like almost like the decision making on the managing partner, on the investor side of the venture capital world now has transitioned to be less of a momentum thing and less of a like trend thing, and being very driven by metrics, very driven by market opportunity, and very driven, I would say, mostly by the founding team and management team execution, right? So the point I'm making here is I think OCN's funding round, while it has a mix in between debt and equity, I always say the reason why we might not have struggled so much in terms of the equity side is because our debt partners were very willing to back the deal and move forward, right? But I've seen the other side of the story. I've seen the story where a Latin American company, a US-based company, has the same challenge, needs to have access to both the equity capital and the debt side. And then connecting both of them at the same time and making both investors feel comfortable with one and each other, it's truly complicated, right? Because then you have the debt investor is going to focus on very specific details of the company. And then you have the equity investor that needs to hit home runs on their investment, right? So the point I'm making here is I think venture capital has changed, but for the good. I think founders are aware of this. And I see that 1 year from now, not necessarily today, but 1 year from now, these will create a very active and very positive industry for us.
Well, we very much look forward to that. And huge congratulations to you again. And we will keep an eye on everything that OCN does. And hopefully you can come back again and tell us more about all the wonderful new products and services you're launching in due course. And on that note, we're just going to take a quick pause here. Back shortly. Welcome back. Before we get back into the news, we want to tell you about our latest Insight show. You may or may not know that FedNow turned 1 last week. And to celebrate the first anniversary of the Federal Reserve's instant payment system, we checked in with experts on both sides of the pond to see how it's going so far. Host Kate Moody is joined by guests from Aurum, Modern Treasury, and 11FS. Check it out in our podcast feed. It's just the one below this one. And back to the news. And our next story is that BNP Paribas has partnered Ant International to enhance cross-border payment solutions in Europe. This story came from Fintech Futures. The French banking giant signed a memorandum of understanding in Zurich with China's Ant International to supercharge cross-border payments. Thanks to this partnership, merchants using BNP Paribas will soon accept payments from over 25 international mobile partners via Alipay Plus. They're also diving into blockchain tech with Ant's Whale platform to make global fund settlements faster and more efficient. BNP Paribas also agreed to sponsor UK payment group World First, which was acquired by Ant International for $700 million in 2019 for its participation in the Single Euro Payments Area, or SEPA, scheme. So Nadine, there's a lot to unpack in there. Where would you like to start? How will this partnership and the use of Alipay Plus affect merchants in Europe? What kind of opportunities or challenges do you see arising from this one?
Yeah, absolutely. So I think to start with discussing some of the opportunities, probably the most obvious one is access to Alipay users. This is because now European merchants who use BNP Paribas, like you mentioned, will be able to actually accept payments from the vast user base of Alipay Plus. And according to Alipay Alipay Plus's website, they have over 1.5 billion consumers. So that just kind of paints a bit of a picture around the size of their user base and how it will open up significant opportunities to cater perhaps specifically to Chinese tourists and expats who prefer using Alipay because that's the platform that they're most used to. So then I guess that leads into quite nicely the second key opportunity, which is around attracting more tourists. So this might be a broader, I guess, benefit for the European Union and not just merchants in Europe, but actually the ability to accept Alipay and other Alipay Plus partner wallets will definitely mean that European merchants are more attractive to tourists from Asia, particularly Chinese tourists who are very accustomed to using those mobile payment solutions back home. And I think that then highlights the third key opportunity, specifically for those European merchants around higher spending. And I guess the rationale here is that as a consumer, if you are able to use a payment method that is very familiar to you, you will probably end up spending more. I think we've all been in a situation where we've gone to buy something in a store and they don't accept Amex because that is the most consistent example that happens. And then either you walk away because you don't have another payment option, or you have to use a payment option that perhaps you didn't really want to use. So I think the combination of those three, access to a really massive user base, attracting more tourists and enabling higher spending are probably the key opportunities there.
And Anita, what does this sort of signal in terms of Ant's ambitions? Are they sort of trying to get that stronger foothold in Europe? And I don't know how much this is publicized on your side of the pond, but they had a huge marketing push for the Alipay Plus brand as part of the Euros football championships. Their name was all over advertising boards, and they also designed some of the trophies for the events. It was all over the advertising on television as well. They've done a huge marketing push in this market. What does that tell us more broadly about their ambitions, do you think?
Yeah, I mean, it makes a lot of sense, the desire to expand globally, especially right now. I think that, taking a step back, we've heard this narrative about the world entering a period of deglobalization and, countries and regions increasingly deciding to sort of, retreat from more global economic activity. But when you look at cross-border payments specifically, it tells a completely different story. Most analyst projections that I've seen still expect that market to continue growing at a pretty healthy clip over the next couple of years. And that's just, it's for a lot of reasons. You have underbanked populations who are sort of coming into the system. You have some of the supply chain issues that we saw really play out during the pandemic that continue to persist. And there's more need and desire from companies to transact across borders. So I think it just underscores that this continues to be a really important area and an area of growth, even as deglobalization might be happening in other corners of the market.
Absolutely. And Mairon, what's your thoughts on that? And running the platform, as you discussed, in multiple different locations. What's your thoughts on the cross-border element of this in terms of the growth opportunities there?
Okay, I think it's very interesting. I think the company is targeting different markets. And of course, from the company perspective, it makes sense to do so at this specific point in time. I think it's, of course, from the market size perspective, always very interesting as an opportunity, right? Now, there's a point to be made on the fact of how much utilization from the user base are going to have on all of this infrastructure that they will need to develop and be invested into, right? So I'm pretty sure they've run the numbers, pretty sure they make sense for themselves. But I'm truly excited to see like companies taking, I would say this opportunity to just go cross border. Of course, meaning of investment from the company side, but in the end, the opportunity is there. I think it's great from the company perspective for sure.
And Miguel, what's your take? It's relatively unusual to see a sort of European banking giant partner with one of these Asian conglomerates. Do you think we'll see more of these collaborations? Is there anything sort of from a regulatory standpoint that could come into play here and potentially either be a challenge or an opportunity?
So there's a reason why a huge chunk of successful fintech companies are payments companies, right? And I think there's a lot of attention these days, specifically in cross-border payments. I was pulling some numbers, and I think it's about $500 billion in daily flow for cross-border payments, right? I mean, Stripe last year did $1 trillion in payments. That's 2 days of cross-border payments globally. But the reality of all those cross-border payments is that the average cost for a $200 payment cross-border is about 6 to 7%, right? And this is coming from the World Bank. I know, Nadine, this is the second time we're quoting the World Bank, but they do good research. So, that means that it's still expensive to send payments across borders. And companies like Ant or banks like BNP, that's a big chunk of their flows. So yes, we are going to be seeing more of these partnerships, because if you drive costs down, you can certainly affect volumes and demand to go up, right? And obviously they're aiming for convenience, but they're also aiming for better costs for their users. And it's interesting, now we're seeing these kinds of initiatives driven by the private market, but also by the public sector in different geographies, right? The Central Bank of Brazil is famous for pioneering their own real-time payment system called Pix. Well, they are now in multiple talks with central banks around the world. So number one, those banks in different parts of the world can develop their own version of Pix. But then there's even talk of making this, just connecting those systems and making them interoperable. Again, more institutions, more companies targeting cross-border payments and trying to make them more affordable.
Absolutely. And Nadine, I want to touch very quickly on the sort of world first and SEPA, or single euro payments area, kind of integration. What does this mean in terms of how impactful could this be? Kind of, BNP sponsoring and international to access this kind of multinational payments system.
Yeah, definitely. I think it speaks to the wider ambition of BNP Paribas here. I mean, it's very clear that through this collaboration partnership with Ant International, one of the greatest bits of value that BNP Paribas can derive is around access to Ant Group's technology. This is really going to put them at the forefront of innovation in, kind of the entire financial services sector. And I think there are probably a lot of banks and fintech players who are sitting back and reading this story in a lot of detail, because like both you, Laura, and Miguel touched on it, it is quite an unusual move for a major European bank. So I think they kind of go hand in hand. BNP Paribas now have access to, all of this amazing cutting edge technology in digital payments, fraud prevention, things like user authentication as well, which is going to be very beneficial to them in competing with their major bank and fintech partners. And then on the flip side, like you just touched on, Ant International is now getting exposure to the kind of world first, the single euro payments area, SEPA. And for those who don't know, it's a payment integration initiative by the EU. And the aim of it is to simplify bank transfers denominated in euros to try and make those cross-border payments as easy as possible. So I think it just really shows how beneficial this partnership is to both parties.
Absolutely. And we'll, again, keep an eye on this one, see what happens next, and also who might be next in line for them to partner with. As you say, like a lot of other banks are probably taking note of this one and looking at what they can do as well. So I'm going to move us to our next story, which is 13 Books Capital raises £121 million in a fintech fund. This story was in Finextra. So despite tough times for fundraising, says Finextra, although perhaps we think otherwise on this discussion already had today, London's 13 Books Capital just closed a hefty £121 million fund to back the future stars of fintech. Since 2019, 13 Books has already invested in 19 fintech firms, from Roadzen to ErisX. Now they're gearing up for more with their fresh pot of cash. The new fund welcomes British Patient Capital and KfW Germany as backers, alongside Isomer Capital and IPGL. With ticket sizes ranging from £1 to £7 million, 13 Books aims to nurture fintech startups from seed to Series A stages. So Nadine, as discussed, we are here in London, so we are a huge global fintech hub. This feels like a good thing for London-based fintechs, would you say?
Yeah, absolutely. I think it's interesting because it ties in quite nicely with the discussion that we were having earlier on, and Mairon articulated the, funding landscape really well. So I'm not going to try and replicate what he said, but I think it's very positive, especially given the fact that global fintech investment hasn't been great. According to Innovate Finance, globally it fell by 19% in H1 24 compared to H2 23 due to the economic slowdown. So the fact that, we're seeing this, also Innovate Finance has confirmed that the UK received the second most fintech investment globally in H1 24 is really positive. And for me, the other point that was quite interesting from Innovate Finance was that there has been a noticeable shift towards earlier stage deals, so seed to Series B rounds. And I think that's super interesting because it aligns very well with this news article about 13 Books Capital, and specifically, I suppose, their investment strategy, which is to target those companies who are seed to Series A stages. And there are a number of reasons for that, and Miguel is probably much better suited to speak about this than I am, but I can maybe give some of the potential benefits, and Miguel, you jump in and tell me if I'm talking nonsense, and then perhaps you give the flip side of the risks. But I think, firstly, when thinking of those earlier stage companies, there's probably higher potential returns, because if you're capturing significant equity at those lower valuations, then hopefully by the time you want to exit, you can do quite well. I think Mairon actually touched on it earlier as well, a point around influence and control when thinking about Stripe and the founders and perhaps the relationship that they have with Sequoia. I'm sure that they receive lots of proactive support, lots of active involvement. So I think that's probably a really key reason here as well. We've also spoken quite a bit around technological innovation from the previous story around Ant and BNP Paribas, but I think that's also an obvious reason here, which is the fact that those seed and Series A startups are typically at the forefront of technological innovation. So it's going to be much more compelling, perhaps, for investors to want to get in at those early stages. And then maybe the last point that I'll give before passing over to Miguel is around, I guess, building those long-term relationships. If you come in early, then you can kind of be with the company, be with the founders, be with that management team through the entire journey, which I think is also a pretty cool thing to do.
That's what you were saying about Sequoia and Stripe, for sure, right? Miguel, what would you add to that?
You really have to admire what 13 Books has done, because unless your name is Sequoia, Andreessen Horowitz, or Benchmark, or any other fund in that tier, it's a hard time for funds to raise capital. And of course, it's harder for fintech funds than it was before. But what we've observed, and this is certainly something related to 13 Books, is that tourist investors are out. And what that means is fintech investors today understand fintech, right? In 2021, in the US, 1/4, so 25% of VC investment was in fintech. Now it's certainly come down. I think last year was about 10%. But although it's a big drop, 10% is, the share of financial services in the US GDP. So it actually makes sense for it to be a 10%. And so for 13 Books, I think the appeal for investors and also for founders taking their money is their fintech focus, right? They speak the language, They understand the market better. And so I think for financial services, specialist investors are going to be rewarded. And certainly it's a better time to invest because companies are not going to have as many options. So you can arguably get a more attractive valuation.
Absolutely. And doubling down on that, obviously, it's great to have investors that kind of know what you're about and what you do and kind of really buy in to the business model from the beginning, as you were saying. Speaking about that beginning stage, so Mairon, as someone who's just raised a Series A, what's your thought on this? Is this the most needed stage for investors to really focus on? Is this a good starting point for them to take in terms of supporting fintechs at the earliest stage of their journeys? Is this where capital is most needed for some of these companies to really get up and running?
I would say for sure, right? I mean, seed, Series A is where true innovation happens, right? Whenever a company is Series B, Series C, innovation happens by replicating what they did well at the beginning. And of course, you can iterate always, but of course, innovation happens at this stage, and seeing investors raising big funds for this, I think it's really admirable, because as Miguel was saying, I think for startups, as long as you have a compelling product, a very strong metrics, and you're capital efficient, you can be successful in raising capital. Whereas that might not be the case for venture capital funds, right? Venture capital funds, I think the market for them to go to LPs, regardless if it is a pension fund, regardless if it is a private investor, I think it's completely different. I think it's way more challenging. And I think the funds that are doing it today is probably a reflection of good decisions made in the past. And as Miguel was saying, I think like tourists, venture capital funds are maybe not out of the play completely, but for sure well down than they used to be a couple of years ago, right? So to the point you were making, Nadine, I think this relationship that has to be built in day zero for a seed Series A investor to invest in a company will naturally evolve as the company grows and as the company scale. We need to understand from pre-seed, seed, and Series A investors that they need home runs, right? And unfortunately, that is a reality, right? A venture capital investor will need, if not most, but a good portion of the portfolio to be good returns, because they're going to have a very large part of the portfolio that is not going to turn a return on investment, right? And the point I'm making here is the investor has to be fully convinced on the founding team, on the thesis, and on the market opportunity for them to actually be involved in the long term, right? These are the investors that are going to be for the next 5, 10 years, 15 years, with the founder, with the company, with the management team working towards their success, right? And naturally, the relationship has to evolve, right? The Series A investor that as part of the investment is asking for the board seat, maybe it's not always going to be the case, and depends, of course, on a lot of the fund, depends on a lot of the partner, but needs to be aware that probably a Series B, Series C investor, or growth stage investor is going to manage and want to manage the relationship between early stage investors and growth stage investors completely different as when they're investing, right? So 2 things, I think, because we understand the dynamics of them being the investor are gonna be involved in the company for the next 5 to 10 years. We need to understand also that relationship must evolve as the company scales and as the company grows.
Great. And then just a final word from you, Anita, as someone who's obviously like reporting on a lot of these raises, a lot of these funds, as Nadine touched on, the UK received the second most fintech investment globally in H1 of 2024. The US, obviously, the sort of top scorer there, as it were. What's the sort of perception of the UK funding scene from your perspective, and how is it different from the US?
Yeah, I think a lot of the challenges faced are quite similar, for fintechs building in the US versus the UK and on the funding side, which we talked about a lot. But one thing that I've been thinking about lately that I think really just speaks to the strength of the UK fintech market in particular is that there are some, regulatory differences as well. I'm thinking about the application process for banking licenses. And here in the US, there hasn't been a single fintech that's actually been granted a banking license by the OCC, I believe since 2021. And, meanwhile, it's a process that moves slow in the UK as well, but there's been some movement there. I saw a headline just recently that the CEO of Revolut is feeling pretty optimistic and confident that after several years of trying to get this license, they're going to finally be able to secure it. So we'll see if that actually happens. But at least in terms of perception, I think that there's a lot of reasons to be optimistic about the future of fintech in the UK.
Absolutely. I mean, he alone can attest to how long these things take. They've been waiting quite a while. But the fact that they are coming out and saying like it is definitely on the table now is very, very positive, as you say. Okay, so now for a quick look at a couple of more click-worthy news stories this week that we don't have time to cover in full. And this week we are touching on Monzo, which is going to launch a bank account for children. So this story was in Finextra. The UK digital bank has just launched a wait list for a new account package for kids aged 6 to 15. They will be able to set savings goals, organise money with savings pots, access in-app education, and choose a brightly coloured yellow, blue, or pink neon Monzo card. And to give their parents peace of mind, they can link their child's account to their own, get notifications on spending, set spending limits, and even control cash withdrawals and online payments. And Monzo CEO T.S. Anil says that this is a big step in their mission to make money work for everyone. Nadine, what was your reaction to this one?
Yeah, firstly, I suppose just a bit of a comment from the work that I do. I work with a number of different banking clients across the UK, and I think this is definitely in line with strategies that a lot of the players are wanting to explore in more detail, which is around products for children. So I think firstly, it's great to see more competition in the market on this. For me, the main purpose of these kids' account is to encourage saving behaviors, financial education, practice money management in a very real setting, and also encourage financial independence. And some of the other players who are doing this are, Go Henry, Starling has a children's account, Starling Kite. That being said, I personally feel quite passionately also around, smartphone access to children. If I think about a child aged 6 potentially being given a smartphone so that they can download a banking app and set goals, etc., that does make me slightly nervous. So I think I would just encourage parents to think through the appropriate age at which to give your child a smartphone that has a banking app installed on it. I think back to when I was younger, and I was quite lucky that my parents were, very focused on financial education. I was given a debit card, I think, when I was 14, that was linked to my parents' account. I had a little allowance on it, so I knew how much I could and couldn't spend. So I think ultimately this is trying to mimic that in a much more evolved manner. So let's see how it does when it launches.
Absolutely. And if you want to know more about T.S. Anil and Monzo's mission to make money work for everyone, tune into episode 844 of this very podcast, where David Britt is talking to the main man himself. And finally, a look at something a little bit more lighthearted from the world of finance. So this story came from City AM. Use of TikTok and Reddit for financial advice soars among Gen Z and millennial investors. So TikTok and Reddit are becoming hotspots for investment tips among young investors. In just 3 years, the number of 18 to 34-year-olds getting financial advice from Reddit jumped from 17 to 26%, and on TikTok from 12 to 20%. Websites of financial companies are losing their appeal, dropping from 43 to 29% among young investors seeking investment information. And meanwhile, and somewhat perhaps surprisingly, newspapers are making a comeback, almost doubling in usage to 23%. While younger and middle-aged investors flock to social media, only 1% of the over 55s have used it for financial information. So, does anyone want to put their hands up? Has anyone on the panel used TikTok or Reddit, just as a general platform? Okay, Miguel, Anita. Has anyone made an investment based on what they've seen on TikTok or Reddit? Miguel's got to keep his hand down for this one. Okay, so is there anything surprising in the stats on here? Is that what we'd expect? Should we be concerned about people getting their advice from social media? Miguel, let's start with you.
So it's not that surprising, but it is concerning. It's not surprising because I think all of us here and people have been getting at least a portion of their news from social media for a long time. So if you get your news, then obviously you're also going to get advice, be it travel advice, then that turns into financial advice. The problem with that is that there's a lot of irresponsible advice from so-called financial experts circulating around, especially TikTok. I don't know about Reddit that much. I'm not a TikTok user, but I've seen definitely some things that you would just like say, who is this clown? So I hope there'll be more professional advisors coming into TikTok. You just gotta follow your audience. So don't fight it. Just join TikTok if you're a good financial advisor.
Okay, if you can't beat them, join them. Is that what we're saying? Anita, what's your thoughts on this?
I mean, I definitely see where this push is coming from. And it makes sense to me, actually, even though it sounds counterintuitive, why newspapers were also becoming more popular as places to seek this sort of advice. I think it's because, the younger generation really wants to feel empowered and wants to feel like they can make that decision and take it into their own hands. And so some of these things are just, they should be used just as tools and not always taken literally. And obviously, there should be a degree of scrutiny that you look at any content that you see online, even from a newspaper, to be honest. Why are they saying this? What might the incentives be? How was this information concluded? But I don't think it's necessarily a bad thing that people are searching for more avenues to just gain more information and more insight. I think it has to be all taken together. Maybe a post that you see on Reddit sparks an interesting idea, but then you want to do your own research and think about how that fits into your financial picture, which is where the help of a professional could be really useful. So I say it's not really one or the other. I see it as more of a, social media can be a really nice supplementary tool to sort of, get you thinking creatively and get you thinking in different ways and teach you new things you might not have otherwise known.
Yeah, that's such a good point. And I think we're slightly coming up on time, but in the kind of spirit of getting advice from social media, if not necessarily financial advice, just as a sort of lighthearted place to end on, what's the best tip, trick, or hack that you've learned from social media? Doesn't have to be financial. For me personally, I like saving recipes, and particularly like you get a great picture of an amazing cake, and I'm like, I want to save how you made that and try it myself. Nadine, how about you?
Yeah, I of course can't think of an actual specific example, but my mum loves sending on Instagram to our family group, like all of these hacks, like household hacks that you would never have known, certain devices that you have in your kitchen, this is the correct way to use it. And so I've certainly learned a lot from those, although perhaps not if I can't actually give you a specific example right now.
You perhaps have it stuck in your head. Mairon, how about you?
Well, I am a big YouTube consumer. I don't know if I would say of the good part of YouTube. And actually, it's very interesting because when we were, and I'm going to link it to OCN, right? But when we were thinking about launching the US, YouTube, because in the US, there are like very niche forums, was very helpful to get very, I would say, insider data on the market that we were about to enter, right? So I would say YouTube is like one of my, like the earliest sorts of information when I'm trying to look up for something. And then of course you'll get into more that, then more forums and more analysis, right? But I think it's I think that would be my hack, like the early YouTube information that I get.
YouTube's the entry point. I like it. Miguel?
I think it was almost 10 years ago. I was listening to one of the first episodes of Tim Ferriss, the Tim Ferriss podcast. And I remember his guest talking about the best purchase that they had made under $1,000. And it was a Tumi backpack. Very expensive for a backpack, but I went ahead and bought it. And 10 years later, I use it almost every day. It still looks like almost new. And I remember my high school backpacks, after 3 months, they looked like crap. So highly recommended.
Amazing. Look at that. Like an influencer post that kind of got you. But it's good stuff. It worked. And Anita kind of closes out. What's the best tip, trick, or hack from social media or beyond for you?
I get so many hacks from social media, so I had to think about this one for a second. So I'm glad you went with me last, but, I think it was really helpful in my move, honestly, just looking at places, on Reddit and kind of searching where should I move in San Francisco if these are the types of, lifestyle things that I'm optimizing for. It's nice also, on platforms like TikTok and YouTube to actually be able to see a little bit of the neighborhood and, have some influencer take you and show you around. So I found that really helpful just in terms of figuring out where to live and how to set up my apartment.
Oh, amazing. That's definitely a good hack if it helped you move house and pick where to live next. That's fantastic. And on that note, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. Where can people find out a little bit about you and your companies, starting with you, Nadine?
Yeah, feel free to connect with me on LinkedIn. It's Nadine Timmer-Bodenstein.
Thank you. Miguel?
LinkedIn or Twitter, Miguel Armaza, or you can Google the Fintech Leaders podcast, which is everywhere.
Amazing. Mairon?
Same. LinkedIn, and our website is onecurnow.com.
Fantastic. Anita?
You can check out my author page at The Information if you want to see any columns that I've written about fintech companies and other tech businesses. And if you want to find me on social media, I am at Anita Ramaswamy on X.
Fantastic. And as for me, you can find me on LinkedIn, Laura Watkins. You can find me at 11fs.com and also at podcasts at 11fs.com for any content recommendations for this podcast and also to help us make the show better. So thank you so much for listening. Please follow our podcast. Don't forget to leave us a review. And as always, if you want to join the conversation, find us on social media. Just search for 11FS or use that email I just mentioned, podcast at 11fs.com. Thank you very much and goodbye.
Keeping up with all the noise and news from the world of financial services isn't easy. It's easy to get lost in buzzwords, jargon, and industry speak. So sometimes you just need a quick human rundown of the biggest stories. Well, you are in luck. Bite-Sized is our very own weekly newsletter that takes the biggest news stories from financial services and tells you exactly what's happening, why it matters, and what comes next. Bite-Size goes out every Friday at 11 a.m, so you can enjoy it with a coffee as you wrap up your week. Stay up to speed with the fast-moving world of financial services and subscribe today at 11fs.com/newsletters. That's 11fs.com/newsletters.